Hello everyone. Welcome back to our channel. In this video, we're going to talk about private equity, one of the most interesting topics in the finance industry. Private equity is a form of investment in which investors pool money together to invest in private companies. These companies are not publicly traded, meaning their shares are not available for purchase on stock exchanges. Instead, private equity firms buy and sell shares of these companies on private markets. What is private equity? Private equity is a type of investment that involves buying shares in private companies. These companies are not publicly traded, which means their shares cannot be bought or sold on public exchanges. Instead, private equity firms buy and sell shares of these companies on private markets. Private equity firms typically invest in companies that are in the early stages of development, are struggling financially, or are seeking to expand their operations. These companies may not be able to raise funds through traditional financing methods such as issuing stocks or bonds. Private equity firms use their capital and expertise to help these companies grow and become more profitable. They typically hold on to their investments for a few years, and then sell their shares to other investors or take the company public through an initial public offering, IPO. Types of private equity. There are several types of private equity, each with its own characteristics and investment strategies. Venture capital. This type of private equity invests in early-stage companies that have high growth potential. Venture capital firms provide seed funding to help these companies get started, and then provide additional funding as the company grows. Growth equity. Growth equity firms invest in companies that are already established and have a proven track record of success. These companies are seeking to expand their operations, and the growth equity firm provides the funding to help them do so. Buyout. Buyout firms invest in established companies that are struggling financially or are looking to sell. The buyout firm acquires a controlling interest in the company and uses its expertise to turn the company around and make it profitable. Distressed debt. Distressed debt firms invest in companies that are in financial distress and are facing bankruptcy. These firms buy the company's debt at a discount and then work to restructure the company's operations and make it profitable. How private equity works. Private equity firms typically raise money from institutional investors such as pension funds, insurance companies, and wealthy individuals. They use this money to create a fund, which is then used to invest in private companies. Private equity firms typically charge a management fee of 1–2% of the fund's total assets, and also take a percentage of the profits generated by the fund, typically around 20%. The private equity firm then works with the company's management team to improve the company's operations, increase its profitability, and create value for investors. This may involve restructuring the company, cutting costs, or investing in new products or services. Once the company has been turned around, the private equity firm will typically sell its shares to other investors or take the company public through an initial public offering, IPO. Advantages and disadvantages of private equity. Private equity has several advantages and disadvantages for investors. Advantages. High returns. Private equity investments have the potential to generate high returns, as the companies they invest in are often in the early stages of development and have high growth potential. Active management. Private equity firms are actively involved in managing the companies they invest in, which can help improve the company's operations and increase its profitability. Diversification. Private equity can be a good way to diversify a portfolio, as it is not directly correlated with the stock market. Disadvantages. Illiquid. Private equity investments are illiquid, meaning they cannot be easily sold. Investors must typically hold on to their investments for several years before they can sell their shares. High risk. Private equity investments are generally considered to be high-risk investments, as the companies they invest in are often in the early stages of development and may not have a proven track record of success. Limited transparency. Private equity investments are not subject to the same level of regulation as public companies, which can make it difficult for investors to assess the risks associated with their investments. Private equity is a form of investment that involves buying shares in private companies. Private equity firms use their capital and expertise to help these companies grow and become more profitable, and then sell their shares to other investors or take the company public through an IPO. There are several types of private equity, each with its own characteristics and investment strategies. Private equity has several advantages, including high returns and active management, but also has several disadvantages, including illiquidity and high risk. If you're considering investing in private equity, it's important to do your research and understand the risks involved. As always, it's a good idea to speak with a financial advisor before making any investment decisions. Additionally, it's important to note that private equity investments are typically only available to accredited investors, which are individuals or institutions that meet certain financial criteria set by the Securities and Exchange Commission, SEC. This includes having a net worth of at least $1 million or an annual income of at least $200,000. Despite these limitations, private equity can be a valuable addition to a well-diversified investment portfolio. It can provide opportunities for high returns and active management, as well as exposure to a different segment of the market than traditional stocks and bonds. It's also worth noting that private equity has been the subject of controversy in recent years. Critics argue that private equity firms prioritize short-term profits over long-term growth, and that their actions can have negative consequences for employees and other stakeholders in the companies they invest in. However, supporters of private equity argue that it plays an important role in fostering innovation and growth in the economy.